with this topic, we shall be discussing what is dividends, what are the theories of dividend policy, should company pay dividend or not, how much should company pay as dividends, what are the factors that determine dividend payments, what are the forms of dividend payments. All right, let's go to this topic. There are three main duties of finance manager. There are three main duties of finance manager. Please note, there are three major responsibilities of finance manager. One is investment decision making. The finance manager must be involved in the investment decision making. Number two is financing decision making. The finance manager must understand the different type of finance and the implication of each finance method. Number three is dividend decision. The finance manager must be involved in the dividend payment, dividend policy of the company. Now, if you look at it, it is generally believed that companies are in business to maximize the wealth of the shareholders. The primary objective of a business organization is to maximize the wealth of the shareholders. To maximize the wealth of the shareholders, the company must identify business opportunities. The company must identify investment opportunities. After identifying investment opportunities, these investment opportunities must be subjected to financial evaluation. After identifying investment opportunity, these investment opportunities must be subjected to financial evaluation. That is, you are going to carry out investment appraisal. You are going to appraise whether the investment is financially viable or not. This will happen at the investment decision making. Usually, you use the net present value method to evaluate a capital project. Usually, we use the net present value method to evaluate if the project is financially viable. All this will happen at the investment decision making. Finance manager must be involved in the investment analysis. Now, if the project is financially viable, that is, excuse me, please. Please, excuse me, please. Hold on, please. If the investment is financially viable, that is, the investment has a positive net present value. The investment has a positive net present value. We are going to agree that the project is financially viable. Then the company can undertake the project. That is, you are going to comment that this project is financially viable. Management should accept the project. Management should undertake the project. After that, the next question is, how do we finance viable projects? After you have addressed investment decision, the next question will be, how do we finance viable investment projects? You now look at the different financing: equity financing, debt financing, Islamic financing. You are now going to ask yourself, that is the question under financing decision. How should we finance a viable project? You can decide to use equity, or you can use debt, or you can use combination of equity and debt, or you can introduce Islamic finance. This question will be answered under financing decision. Now, when you are done with investment decision, you are done with financing decision. We now generate profit for the business. We now realize profit for the business. The third responsibility of the finance manager is dividend decision making. The finance manager must decide what percentage of the company's profit must be paid to the shareholders as dividends. The finance director must decide what percentage of the company's profit should be paid to shareholders as dividends. Now, look at the introduction. The question is, what is dividends? My question to the class now is, what is dividends? You can define dividend as the percentage of the company's distributable profits. Percentage of company's distributable profits that is paid to shareholders in form of dividends, that is paid out to shareholders. Dividends is the percentage of profits after tax that is paid to shareholders, usually in the form of cash. We have defined dividends. Percentage of the company's profits that is paid to shareholders in the form of cash. Now, please note, the directors is at liberty to decide the amount to pay as dividends. I will repeat that point. Dividend payments is at the discretion of the company's directors. Dividend payments is at the discretion of the company's director. The director can decide to pay all the profit as dividends, or the director can decide not to pay dividend at all and retain all the profits, or the director can decide to pay certain percentage of the profit as dividends. Dividend payments is at the discretion. Let's continue. I'm hoping that the network, we are hoping that the network will be stable for a longer time. All right. We have defined what is dividend. Next, theories of dividend policy. There are several theories about dividend policy. These theories are intended to identify the optimal amount of dividend that a company should pay to shareholders. We have many theories of dividends. These theories are intended to identify the optimal amount of dividends a company should pay to the shareholders. Now, the question you are going to ask is, what is optimal amount of dividends? The question you are likely to ask me is, what is optimal amount of dividend? Optimal amount of dividends is that dividend payment that will maximize value of the company shares. Please, you can write it down. Optimal amount of dividends is that dividend payment that will maximize the market value of the company's shares. You can put this down. Optimal amount of dividends is that dividend payments that will maximize the market value of the company's shares. All right. There are three major theories of dividend policy. There are three major theories of dividend policy. One is the traditional theory of dividend policy, also known as the relevance theory of dividends. Number 2, Modigliani and Miller, dividend irrelevant theory. And number 3, residual theory of dividends. There are 3 main theories of dividends. One is the traditional theory of dividend policy, otherwise known as relevance theory of dividends. Number 2 is Modigliani and Miller, dividend irrelevant theory. Then number 3 is residual theory of dividend. Let's go to this. The traditional view of dividend policy. This school of thought argues that the amount of dividend payments, the traditional theory of dividend policy argues that the amount of dividend payments should be at a level that enables the company to maximize the value of its shares. The traditional view of dividend policy argues that the amount of dividend payments should be at a level that enables the company to maximize the value of its shares. In other words, this theory says that companies should pay dividends regularly. Companies should pay dividends consistently because payment of dividends will maximize the company's market value. Companies should pay dividends regularly. Companies should pay dividends consistently because dividend payments will enhance the company's market value. But you must determine the amount that will maximize your value. According to this theory, retained earnings will add to equity growth in the future. Earnings growth will enable the company to increase dividend payments in the future. So companies should strike a balance. A company should strike a balance between retained earnings and dividend payouts. To this theory, dividend is all that matters in determining share price. According to this theory, value of the company's share price is a combination of dividends, required shareholders' return, and the growth rate. Okay, Oluwakemi. Oluwakemi say we should explain how dividends will maximize value of the company. Let me show you something briefly. Let me show something briefly here. We said, according to this theory, value of shares is a combination of dividends plus growth divided by required return on equity minus growth. This is the formula this theory has given us. According to this theory, look at it, please. Yeah, look at it. It is stated that the price of shares depends on the combination of dividends, given shareholder required rate of return, and the growth rate. How does this translate to maximizing share value? A company will have different ratios. You are not going to look at that ratio that maximizes your value. Once you determine a dividend ratio, dividend payout ratio that maximizes your value, that is your optimum level of dividend payments. When we get to question today, hopefully we are going to demonstrate this. So in summary, this theory is saying that a company should pay dividends consistently. Because, a clean field.
So in done the scriptures that we pay, but it's not all the scriptures that we done. So they will not be paying us just 20. But when I asked my friend, she said I can't apply it because I'm graduating in 3 years, so that I can't apply it now.
The man is not even aware that a speaker is conflicting the class. Let's go on. Okay. The argument of the traditional school was developed or was based on certain reasons. Arguments for the traditional theory of dividends are premised on the following points. What are these points? One is, what we are trying to say is, the traditional school says dividend payments will have impact on companies' market value. The traditional theory of dividends argues that dividend payments will have impact on a company's share value. And they supported their argument with the following reasons. One is dividend signals. Look at it, please. Let me expand this thing more. All right. Number one is dividend signals. What this means is that dividends payments is a means of communicating to the shareholders and the investing public about the performance of the company without saying anything. If a company is paying dividends regularly, investor will believe that the company is doing well. That dividend payments is a means of communicating information to the shareholders and the investing public about the performance of the company. Naturally, if a company is paying you dividends every year, you are going to believe that this company is doing well. It means that dividends comes with information. We call it informational content of dividends. We call it informational content of dividends. Naturally, if somebody is giving you money every day, you are going to believe that that person has money. That person is doing well. Without saying anything, our belief is that a company that pays dividends regularly, the company is performing very well. Because you pay the many investors will prefer a cash dividend. Many investors will prefer cash dividends because it provides current income. As opposed to capital gain, most investors will favor cash dividends. Pay us dividends every year because that dividend will give us current income. This implies that many shareholders will prefer companies who pay regular cash dividends and we therefore value the shares more highly. Many shareholders will prefer companies that pay dividends regularly, and we are going to value the shares of the company more. That is the argument of the traditional school. Preference for current income. Number 3, resolution of uncertainty. Number 3, resolution of uncertainty. Please, 1 minute. Let's go on. One argument often put forward for high dividend payouts for high dividend payouts is that income in the form of dividends is more secured. Please hold. Please hold. I will explain that again. Let me take that explanation again. Let's continue. One argument often put forward for high dividend payouts is that income in the form of dividends is more secured than income in the form of capital gain. Let me explain that. If a company pays you dividends, you are going to have your cash in your hand. Your cash is with you. Alternatively, if the company is not paying dividends, that means the company will reinvest the money. That reinvestment, the company will retain the money. The company will retain and reinvest the money. By retaining your money, we expect that the share price will rise. Rise in your share price will give rise to capital gain. If you sell your shares, assuming you purchase the shares for 100 naira, assuming you purchase these shares for 100 naira per unit, a share now was 150 naira per unit. That means there's capital appreciation. The value of your share has appreciated. That difference is 150 minus 100 naira. That 50 naira is called capital gain. You can only realize the capital gain if you sell your shares. You can only realize capital gain if the investor decides to sell his or her shares. In other words, the argument is, if you pay shareholders dividends, they feel more secured because they have the cash with them than the income they will get from capital gain. Hence, the payment of dividends is a resolution of uncertainty associated with capital gain. Capital gain is not certain. Share price can fluctuate regularly. Today, your share price may rise. Tomorrow, your share price may fall. That means capital gain or capital appreciation is not stable. Dividend payment, income from dividend payments is more stable. That is why the traditional school argues that dividend payments is a resolution of uncertainty associated with capital gain. To place more value on high payout shares, investors will give more value to shares that pay dividend regularly. Investors will give more preference to a company that is paying dividend regularly. Or the bird in the hand theory. The English will say a bird at hand worth two. The money you have received in the form of cash dividends is safer than the capital appreciation you are not sure of. The last point, in support of traditional school, taxation. In many situations, income in the form of dividends is taxed in a different way from income in the form of capital gain. Let me take that again. In many cases, the income you get from dividends is taxed differently from the income you get in the form of capital gain. This distortion in the personal tax system can have impact on investor preference. Distortion in the personal tax system can have impact on investors' preference. Let me explain that briefly. If I receive dividends, I'm going to look at the tax, the withholding tax on dividends. Dividend is subject to withholding tax. Alternatively, if I go for capital appreciation, the tax is different. I will now ask myself, which of this income is tax friendly? I'm going to ask myself, which of this income is tax friendly? If dividend is tax friendly, I will prefer to receive my income in the form of dividends. That will have impact on investors' preference. From the corporate point of view, this further complicates dividend decision. Taxation further complicates dividend decision because different group of shareholders are likely to have or are likely to prefer different payout pattern. That's a challenge. And that is the argument this school is talking about, that the tax will have impact on your policy. And because the tax on dividend income is cheaper, most investors will favor dividend payments. All right. That is the explanation as regards the traditional theory of dividends. In summary, this theory is saying that it is good for company to pay dividends. This theory is saying that there's an optimal level of dividend payments, and that optimal level is achieved at a point of dividend payments that will maximize the market value of the company's equity. That is the traditional theory. Any question, please? Number 2, Modigliani and Miller, dividends irrelevant theory. Look at that word. Modigliani and Miller, dividends irrelevant theory. Modigliani and Miller developed a theory to suggest that dividend policy is not relevant. Modigliani and Miller developed a theory to suggest that dividend policy is not relevant, and the level of dividend payout by a company does not matter. The level of dividend payments does not matter. A company can decide to pay all its profit as dividends, 100% of your profit. You can decide to pay it as dividends. Or a company can decide not to pay dividend at all. Or you can decide to pay any percentage of your profit as dividend. This will not affect the total market value of the company. That is the argument of M and M. The amount of dividend payments is not relevant to company's market value. Dividend payments will not affect a company's market value. That is the argument of the Modigliani and Miller theory. They are saying that why should we bother about dividend payments? Why should we bother about dividend policy? If you like, use all your profits to pay dividends. That means no retained earnings. If you like, don't pay dividends. Retain all the profits. If you like, pay any percentage of your profit as dividends. This will not have any impact on the company's market value. Their theory was based on certain assumptions. One of these assumptions is that taxation can be ignored. M argued that we should assume that there is no taxation in the economy. Companies are not expected to pay tax. According to M, what determines a company's value is the earnings capacity, not dividends policy. What determines a company's value is for the company to be able to generate higher returns, higher earnings. It is your earnings capacity, your earnings power that will determine your value, not the amount you pay as dividends. That is the position of Modigliani and Miller. This theory was developed upon certain assumptions. One of them we have mentioned, a tax-free economy. Number two assumption, market situation. A market where there is no imperfection, no transaction cost, no issue cost. There is perfect information. Now, if a company is not paying you dividends, according to this theory, if a company is not paying dividends, that means you are retaining all the profit. The company must invest this retained profits into viable projects. The choice is between paying dividends or retaining the profits. If you are not paying dividends, then the company must identify viable investment projects that the retained earnings will be invested in. In as much as you are investing in viable projects, value of the company will remain consistent. So if the company is not paying you dividends, where the company decides to retain all the profits, MMM is saying that any shareholder that requires dividends can decide to sell some of his shares to generate cash. MMM is saying that if a company is not paying you dividends, the company should reinvest the money on your behalf. Now, if you require dividend as a shareholder, you can decide to manufacture dividends yourself. How do you do this? You can sell some of your shares to generate cash. It doesn't matter how the cash comes. You can sell some of your shares with an intent to realize cash. Provided the company invests in viable projects, you are going to get your money back. And there is no transaction cost. You can buy and sell shares without incurring transaction cost because it's a perfect market situation. Alternatively, the company can decide to pay out all its profits as dividend to shareholders. Alternatively, the company can decide to pay out all its profit as dividend. That means no retained earnings. If the company decides to pay out all its profit as dividends, if the company requires funds for new projects, if the company requires finance for new projects, the company can decide to issue new shares. You can issue new shares to the shareholders or to the public so as to source finance. By issuing new shares, you are going to generate new finance. And because it's a perfect market, there is no issue cost involved. Company can issue shares without incurring issue cost. Value of the company remains unaffected. That is the argument of Modigliani and Miller. In other words, dividends, there is nothing like optimum dividend policy. There is nothing like optimum dividend policy. Dividend policy is not relevant to companies' market value. But if you look at the assumption of M&M is unrealistic. the assumption of Modigliani and Miller are not realistic. Companies are liable to pay tax. And that will affect this theory. There is no perfect market situation. In reality, there is no perfect market situation. That will affect the theory of M&M. If you sell your shares, you are going to incur transaction cost. Transaction cost is not zero. If you sell your shares, the capital gain are subjected to tax. All right. Number 3, the residual theory of dividends. Number 3 is the residual theory of dividends. This theory states that there's an optimal amount of dividends that a company should pay. The residual theory argues that there's an optimal amount of dividend payments a company should pay. And these optimal amounts can be achieved as follows. The optimal amount of dividends can be achieved as follows. 1, if a company has capital investment opportunities with positive NPV, the company should invest in this project first. Let me explain this. Before you talk of dividend payments, before you are going to decide on the amount you are going to pay as dividend, the company will check if there's any investment opportunity to be financed at future periods. The company will check. Assuming we achieve, let me illustrate this more. Assuming we achieve a profit of 500 million at the end of our financial year. Before we decide on the amount to pay as dividends, we are going to look at it. We are going to check if we have investment opportunities with positive net present value. If yes, we are going to invest in this project first because they will add value to the company and its shares. Number 2, the capital to invest in this project should be obtained internally from earnings. You are going to finance viable projects using your internally generated earnings. When you are done financing all viable projects, the balance remaining, number 3, the amount of dividend paid by company should be the residual amount of earnings. The amount paid the amount of dividend paid by a company should be the residual amount of earnings remaining after all the available viable projects has been funded. In this way, the company will maximize its total value and the market price of its shares. This is the principle of residual theory. Let us demonstrate this more. Let us demonstrate this more. Assuming company XYZ PSC. Mr. Ahmed, please hold on. Company XYZ achieve profit after tax of 500 million. That's okay. But company XYZ have 3 projects. These projects A, B, C to be financed at next financial year. This project will cost 100 million. This project 150 million. This project 150 million. And these 3 projects are financially viable. Then, based on residual income, you are going to come here and say, okay, total cost of viable projects 400. You are going to deduct 400 for a year. The balance, after we have financed all viable projects, this balance of 100 million cannot be used for what? Dividend payments. This is the principle of residual theory. Dividends will only be paid after all viable projects has been financed from your earnings, your profits after tax. All right, Mr. Jamil, you can speak.
Okay, thank you very much, sir. I have 2 questions or 2 clarification. Number 1, for how long can a company stay without paying dividend to the shareholders?
Okay.
Number 2, if company fails to pay dividend and there's no any cogent reason, is it possible for shareholder to sue the company? Thank you, sir.
All right. Thank you, sir. And thank you for disturbing our class today. Because your speaker was making noise.
I'm very sorry. It wasn't intentional.
I know. Now your first 2 questions. For how long can a company stay without paying dividends? A company can decide not to pay you dividends for as long as they like. A company can decide that this is our company, we are not paying dividends at all. We are going to be reinvesting all the profits. So if you want to invest in our company, we don't pay dividends. We reinvest all the profits for future growth. So company is not mandatory to pay dividends. Your second question, you can't sue them. What you can do is to sell your shares and go. Is that clear, sir?
Thank you, sir. Thank you.
You can decide to sell your shares and you abandon the company, but you cannot take them to court. The law empowers director to decide on dividend. The highest the shareholder can do is to vote and remove the director. You can say, let's change them. After their tenure, you can change them. But you can't do anything to them. All right. Wow. Dividend capacity. Dividend capacity means the ability of a firm to pay dividend to shareholders at any given time. A company's dividend capacity can be defined as the ability of the company to pay dividend to shareholders at any given time. A firm dividend capacity is determined by the amount of accumulated distributable profits. A firm's dividend capacity is determined by the amount of the accumulated distributable profits. That is the amount available for distribution. What are the factors that will influence dividend payments? What are the factors that will influence dividend payment? Number one, the legal position. Legally, the firm's dividend capacity is determined by the amount of accumulated distributable profits. The higher your accumulated distributable profits, the more dividends you can pay. Law says you can only pay dividends out of your accumulated distributable profits. The higher the accumulated distributable profits, the better your chances of paying dividends. Number two factor, level of profitability. Profit is obviously an essential requirement for dividends. Profit is obviously an essential requirement for dividends. All things being equal, the more stable the profit, the greater the proportion of dividend payouts. Number three, the growth rate. A growing company is likely to pay low dividends. If your company is just growing, you are likely to pay less dividends and retain more of your profits. Number 4, control issue. That is ownership and control structure. To preserve ownership, company may decide to pay less dividends and retain the profits more. Retained profit still belong to the shareholders. To preserve the ownership and control structure, a company may prefer to pay less dividends and retain more of the profits, because retained earnings, financing the business with retained earnings will not alter ownership structure. This can affect our dividend policy. Number 5, liquidity and cash flow management. The more liquid a company is, the better the chance of paying dividends. In most cases, companies pay dividends with cash. So, if the cash flow is high, the company can pay more dividends. The impact of taxation. Will affect dividend payments. If the tax rate is high, that will reduce distributable profits. If the tax rate is high, higher tax rate will reduce distributable profits. Reduction in distributable profits will affect the amount of dividend payments. Then we have something like available viable projects or viable opportunities. If a company has viable investment opportunity to finance, that will reduce the amounts paid to shareholders as dividend, because the company will want to retain more of its profits to finance viable projects. Next, objectives of a firm. Dividend policy. When deciding on how much cash to distribute to shareholders, the directors must keep in mind that the firm's objective is to maximize shareholders' value. When deciding on dividend policy, always remember, you are going to look at the dividend policy that maximizes the wealth of the shareholders, because shareholders' wealth maximization is the primary objective of a company. All right. Dividend payout policy should be based on investors' preference for cash dividend now or capital gain in the future from enhanced share value resultant from reinvestments into projects with positive NPV. The choice is between collecting cash dividend now or a capital gain in future. The last aspect of our discussion, forms of dividend payments. The last aspect of our discussion, forms of dividend payment. 1, cash dividends. Cash dividends. This is the most common form of dividends. Whereby cash is paid as dividend to shareholders. This is the most common form of dividends, whereby cash is paid to shareholders as dividends. Note, whenever a company pays cash dividend, the share price is likely to fall. Note, whenever a company pays cash dividend, the company share price is likely to fall by the amount of cash dividend paid. Number 2, scrip dividends, also known as stock dividends. Please look at the spelling. Scrip, S-C-R-I-P, scrip dividends, otherwise known as stock dividend. As an alternative to cash payments, a company can decide to issue additional shares to shareholders as payment of dividends. As an alternative to cash dividend payments, a company can decide to issue additional shares to the shareholders as payment of dividend. A scrip dividend is a dividend paid in the form of new shares. Instead of receiving cash, the shareholders will receive new shares. A scrip dividend is a dividend paid in the form of new shares. Instead of receiving cash, the shareholders will receive new shares. Please note, the rule of the stock exchange might require that when a company wants to make a scrip dividend, the rule of the Security and Exchange Commission, the stock exchange, requires that whenever a company is planning to do scrip dividends, it must provide an alternative cash dividend. Whenever a company wants to do scrip dividends, it must provide an alternative cash dividend so that shareholder can decide, can choose between new shares and cash. So that shareholders can choose between new shares as dividends or cash as dividends. That rule is trying to protect shareholders. Shareholders must not be forced to collect scrip dividends. The company must not force the shareholders to collect stock dividends. Next, you have the advantages of scrip dividends. You know, if you are giving stock as dividends, they can preserve the company cash position. Investors may be able to obtain tax advantage if dividends are paid in form of shares. Number 3, investors looking to expand their holdings can do so without incurring transaction costs. A small scrip dividends issues will not dilute share price significantly. A small scrip dividend issue will not dilute share price significantly. However, if cash is not offered as an alternative, empirical evidence suggests that the share price will tend to fall. If you issue new shares, that means volume of your shares will rise. The rise in the number of shares will lead to fall in share price. Then lastly, scrip dividends will reduce the company's gearing level. That will reduce your financial risk. By doing stock dividends, volume of share will rise. Level of financial gearing is likely to fall. Disadvantages of scrip dividend. 1, it may be seen as a negative signal by the market. That is, the company is experiencing cash flow problems. If you cannot pay cash dividend, that means the market might feel that is the stock market, might feel that you are having cash flow problem. Just 1 minute. Item number 3, share repurchase. We have explained cash dividends, scrip dividends. Let us explain share repurchase. If a company has cash surplus and is overcapitalized, if a company has cash surplus and the company is overcapitalized, that means you have more capital than required. The company can decide to repurchase some of its shares as an alternative to paying out cash in the form of higher dividend. If a company has excess cash and the company is overcapitalized, the company can decide to repurchase, that is, buy back some of its shares as an alternative to paying out the cash in the form of higher dividends. You can go into share buyback. Instead of paying higher dividend to shareholders. Share buyback is another way of returning cash back to the investor. Share buyback is another means of returning cash back to the investor. You can do share buyback instead of paying your shareholders unusually high dividend. Because if you pay high dividends in one particular year, shareholders will have expectation at future period. What are the benefits of share buyback? 1, finding a use for surplus cash. Share buyback, you are able to get a use for surplus cash. Number 2, increasing earnings per share through a reduction in the number of shares in issue. By doing share buyback, it can increase your earnings per share. Share buyback provide opportunity to increase your gearing. You can buy back your shares and increase your borrowing. Remember, debt finance is cheaper than equity finance. Next, why will company do share buyback? At times is to prevent hostile takeover. You can do share buyback with an intent to protect your company against hostile takeover. Limitation of share buyback. It may be hard to arrive at a price that will be fair to the vendor and to the shareholders. It may be difficult to arrive at a price that will be fair both to the vendor and to any shareholders who is not willing to sell the shares. Number two, share repurchase can be seen as an admission that the company cannot make better use of funds than to the shareholders. Imagine you are a company director, you are the MD. You are now returning money back to the shareholders under share repurchase. That would mean that you cannot identify viable projects to put our money. An admission that the company cannot make better use of funds. And lastly, some shareholders may suffer from being taxed on capital gain. If the shares are repurchased at profit, capital gain will apply. Capital gain tax. The last one, stock splits. Stock splits occurs when a company perceives that its stock price may be too high. Stock splits occurs when a company perceives that its stock price may be too high. Stock splits are usually done to increase shares outstanding and to make the share more affordable for investors. Stock splits will increase the volume of shares and the price will be cheaper or more affordable for investors. The objective of stock split is to make the shares cheaper with greater marketability. The objective of stock split is to make the shares cheaper with greater marketability. Then we have bonus issue. Bonus issue is also known as scrip issue or capitalization issue. Bonus issue is also known as scrip issue or capitalization issue. Bonus issue is the issue of additional shares to existing shareholders as bonus, and it involves no cost to the existing shareholders. Bonus issue is the issue of additional shares to existing shareholders at no cost, at zero cost. Bonus issue is the capitalization of equity reserves. Bonus issue is the capitalization of equity reserves. Then we have the rights issue. It's also a way of returning cash to shareholders. Rights issue is an invitation to existing shareholders to purchase additional shares in the company. Rights issue is an invitation to existing shareholders to purchase additional shares in the company. This type of issue gives existing shareholders security called rights. This type of issues give the existing shareholders securities called rights. These rights give the existing shareholders to purchase new shares at a discounted price. Shareholders are buying new shares at a reduced price or subsidized price at a cheaper rate. It's a means of giving shareholders opportunity to make profits. Rights issue is a means of giving the existing shareholders opportunity to make profits on their investment. We are done with the explanation. Any question, please? While we are waiting for question, please go to your study pack, page 158, illustration 2. While we await question, please go to your study pack, page 158, question number 2. If there is no question, let us address this question in 30 minutes. Please, any volunteer can read the question. Who is the class governor? Mr. Ahmed.
I'm not the class governor, sir, but I can read.
Okay, is Kemi the governor? Okay, please go ahead, Mr. Ahmed, read.
Okay, illustration 2. It is argued that shareholders are indifferent between dividends and capital gains, and that the value of a company is determined solely by the earnings power of its assets and investments. You are required to write short notes on the following: 1, cash dividend; 2, scrip dividend; 3, scrip issues.
All right, let's attend to the A part. Write short notes on the following: 1, cash dividends; scrip dividends, and scrip issue. You can mute Mr. Jamil. Now, who is going to explain one? What is cash dividends? Yes. Yeah, okay, Chi. Please go ahead.
Good evening, sir. I just want to make an attempt on the cash dividend. So what you explained earlier is that cash dividend is the most common form of dividend where cash is paid to shareholders. But the challenge with this kind of cash dividend is that whenever a company pays cash dividends, the company share price is likely to drop by the amount of cash dividend that is paid.
Yeah, God bless you, ma. It's the most common form of dividend payment. The problem with this method is whenever, okay, it's the most common form of dividend, whereby cash is paid to shareholders in the form of dividend. The challenge with this method is when a company pays cash dividends, the share price is likely to fall by the amount of dividend paid. All right, thank you. Number 2, scrip dividends. Who is taking this over?
Okay, let me try, sir.
All right, Mary.
Scrip dividend, you said, is also known as stock dividend. That is a kind of dividend that is paid to shareholders in form of a new shares.
Okay.
And in paying these scrip dividends, the company must also make provision for cash dividends.
Correct.
The cash. And this policy is made to protect the interests of the shareholders so that they are not forced to take what they don't want to take. Something
God
like
bless you, ma. The last one, script issue. Any volunteer? Explain script issue. What is script issue? Write short note on script issue. Any volunteer? Oh yeah, oh yeah, oh yeah. Where is this? Okay. I want to believe that we can explain this. Script issue is also known as bonus issue or capitalization issue. Script issue is also known as bonus issue or capitalization issue. This is the issue of new shares to existing shareholders as bonus. It does not involve any cost. Bonus issue or script issue is the capitalization of equity reserves. Please, ladies and gentlemen, this topic, try to read all these principles. In your exam, you are going to see a lot of theoretical questions. Please try to read this principle. All right, the B parts. Mr. Jamil, the B parts.
Iceland PSC has just made earnings of 2,250,000. Its directors are trying to decide on a dividend policy. If they retain 20% of earnings, they believe they can achieve an annual growth rate of 5% in earnings and dividend. If they retain only 10% of earnings, the growth rate will be 2%, and shareholders will expect a return of 14%. You are required to determine which retention policy will maximize the value of the company's shares.
All right, thank you, sir. Let's go to this. You are required to determine which retention policy will maximize the value of the company's shares. Look at the examiner says, if they retain 20% of earnings, look at that. If you are retaining 20% of your earnings, how much are you paying out as dividends? Hello?
Remaining 80%.
Thank you. If you are retaining 80%, sorry, if you are retaining 20% of your earnings, it implies that you are paying out 80% of your earnings as dividends. We can go to this working now. Let me take this off for. All right. We come here. I'll pick my pen. B, policy 1, 20% retain earnings. Therefore, 80% pay out ratio as dividends. This is policy 1. Examiner says if they retain 20%, that means 80% is paid out as dividends. Remember the formula for value of shares. Value of shares is equal to dividends bracket 1 plus G over KE minus G, where D is dividends. That is, for this question, 80% of our earnings. What is the earnings? Earnings is 2,250,000. Let me show you that. Island PSC I just made earnings of 2,250,000. Please compute 80% of that. That is the dividend paid.
1.8 million.
Please compute 80% of this.
1.8 million, sir.
That will give us 1,800,000. Next, your G is the growth rate. Go back to the question. If the retention is 20%, what is the expected growth rate? Look at it. They believe that they can achieve an annual, look at it. If they retain 20% of earnings, they believe that they can achieve annual growth rate of 5%. Pick it. Annual growth rate, 5%. Your K, that is cost of equity, or you can call it shareholders required return. Let's go to the question. Look at it. Shareholders, we expect a return of 14%. That is the shareholders' required return. This is equal to 14%. You can return to the formula. Value, look at the formula, please. Value of shares is equal to D bracket 1 plus growth. That's the value of shares is equal to our D, 1.8 million. Dividend, bracket 1 plus G, our G, 5%, 0.05. divided by KE, required return, 14%, 0.14, minus the growth rate, 0.05. Please work this out. What is the value of the shares if policy 1 is adopted? Final answer? Oh yeah, oh yeah. You can do this straight on your calculator. Or you can do it 1-1. Give me the figure 1-1 if you are not sure.
The up one is 1,890,000.
Value of share is equal to
1,890,000.
890 divided by 0.09.
21 million, sir.
Total answer 21 million. Value here is 21 million naira. For policy 1, value of the company is 21 million. Let us check policy 2. Policy 2. 10% retain earnings. Therefore, if 10% is retained, what is the percentage paid out? 90% pay out ratio as dividends. Your formula for value. Value of shares is equal to D bracket 1 plus G over KE minus G. Now D, dividends. 90% of the earnings is dividends. 90% of our earnings. Our earnings is 2,250,000. What is the dividend here?
2,025,000.
G, the growth rate. Let's go to the question.
2%.
The growth rate will be 2% if they retain only 10% of earnings. Growth rate is 2%. Required return will not change. Shareholders' required return will not change. Our K is still 14%. We can value the company. Value of shares is equal to dividend 2,025,000 bracket 1 plus G 0.02 over KE 0.14 minus 0.02. Value of shares. Please, can we work this out?
The upper one is 2,065,000.
2 million
65,500. 2,065,500
divided by 0.12.
17,212,500.
Total value here
17,212,500.
17 million
212,500.
Thank you. Now compare the two policies. Which of these policy maximizes the value of the shares? Look at it. Summary. For policy 1, value of share is 21 million. Value of shares. For policy 2, value is 17,212. Which of these will the shareholder prefer?
Policy 1.
Policy 1 is best. Policy 1 will increase value of the company shares. Your recommendation. The company should select a dividend policy of 20% retained earnings, as this will maximize value of the company share. You are done with requirement B. The last requirement,
state 3 advantages of retained earnings to a company.
state 3 advantages of retained earnings to a company.
Yeah.
What are the advantages of retained earnings in a company? We discussed this under sources of finance.
Yes.
We discussed this under equity finance sources. What are the advantages, please? Why is it good for company to retain part of its profits?
It creates opportunity for companies to be able to have enough funds to take care of their, to take care of the expansion of the company.
All right. It provides opportunity for company to finance expansion from internally generated funds. It provides opportunities for company to finance expansion from internally generated earnings. Number 2, retained earnings are readily available. The directors do not require approval of shareholders in order to utilize retained earnings. Number 3, retained earnings is at no cost because the finance is readily available with the company. All right, we are done with the question fully. Any question, please? Any clarification, please?
Hello, sir.
Yes.
Okay,
Chidima.
good evening. Good evening. So sorry. It's not a question. It's an appeal. This is my first time of joining the class. Can I get the material?
Oh, you are joining for the first time today. Okay.
Yes.
Okay, sorry for that, really. You should have even, they should have given you as soon as you are added to the platform. You are going to get the material tonight.
Okay, sir. Thank you so much.
Are you on the platform, please?
Yes.
Okay, once you're on the platform, you are going to get it.
Okay. Thank you so much.
All right, sorry for that. They should have given you as soon as.
Thank you.
What do you say, man?
No, it's fine, sir. Maybe I'll reach out to you on WhatsApp.
All right. All right, if there's no question, you can look at the next question. There's a question after that question. Most of the question on this topic is mostly theory. Look at the next question. Mr. Ahmed, are you there?
Yes, sir.
That question is also labeled number 3.
It's labeled number, yes. Question 3.
If you look at that question, you can read. We are going to finish by 11, no problem.
Question 3 states that discuss the main features of the following and include reasons why companies might use them.
Look at it. Let me quickly read, don't worry.
Okay.
Discuss the main features of the following and include reasons why companies might use them. A, corporate share repurchase. 2, share or stock split. This question was tested for 15 marks. What are the features of corporate share repurchase? Why do companies go into share repurchase?
Buyback.
Number B, stock split. What are the features of stock split? Why do companies go into stock split? Include in your discussion comments on possible effects on share price of stock repurchase, share repurchase, and stock splits in comparison to the payment of dividends. Please, you can look at the solution. It has been explained. Please, let's just take advantage of this online class. It's our belief that students can write this exam and pass. Do not accumulate your notes. All right. You can go through this. Share repurchase. You purchase your own shares. You are returning cash back. All right, please, you can read through. May God give us a better understanding. Any question, please?